Good morning, everyone. Today is June 3rd, 2020, and I'm going to go ahead and start the Portfolio Manager Roundtable weekly meeting with our internal sales, support, and analyst teams. So, over the course of the past couple of weeks, we've seen a couple of failed attempts at what is being labeled as a value rotation. And keep in mind that in prior webinars and prior strategy sessions that I've hosted with other advisory firms, I've made the call to basically stick with the growth orientated names. And now we're seeing as of late some reopening type rallies, and these are all fine. When you see these big percentage gains off the lows that they're having, just remember that some of these names are still down 30, 40% when the broader market is only down single digits now. And so they've got potentially some significant catch up to do, but they're cheap again for a reason. Let's not lose sight of that. So in order to take a look at what's going on with overall market valuations, I think it's really, really important to focus on the cyclical space. In other words, those value names. And even more so, let's take a look at a real example of a company like John Deere, who just issued a guidance warning about a week and a half ago. And so in the spirit of keeping with information that's timely, I'll always try to talk about things that are in the news and offer a little bit perhaps different perspective and show you with charts maybe what they're speaking about. Specifically with John Deere, and we'll talk about this relative to the broader market as well. You can see that even despite the soft guidance issued by management at John Deere, we've still got the start of a recovery. And you can see how deep this earnings trough is. And as a matter of fact, if you look at these two X's, you can see we've had one actual quarter report down. We've got two more quarters down before the forecast of what I call earnings normalization begins. And you can see in our valuation model here in the Zacks research system that we've got a normalized earnings column. And as a matter of fact, this is how we value stocks at Zacks. And so this earnings normalization begins. This EPS is lagged by 1 year. So effectively, the end of 2020 into 21, 22. You can see that we've got basically PE multiple stabilization, the distance between these two lines. As a matter of fact, we've got some growth here. And so the takeaway here is that despite the earnings warning, we rolled into this year knowing that equity valuations were going to be determined on companies' abilities to deliver the earnings forecast that they had in place last year for forward 12 months. And we know that with COVID, this period that we're in right now, the buy side has basically taken the next several quarters and tossed them out the window. Okay, for the first time ever, we can look at John Deere and John Deere's valuation similar to a company like Starbucks. And I know this sounds insane, and in many ways it is, but if you think about the underlying principles behind what equity valuation is, the buy side has already digested this year, and they've said, okay, this is a one-time non-recurring event. Let's eliminate that, right? So I worked as an analyst for some time, and this is how we actually, analyzed financials and produced normalized earnings streams. This is not normal, right? This pandemic and the results of the pandemic, this is not normal Starbucks operations. Starbucks has much longer business hours. They allow people into their restaurants normally. So you can see this concept of earnings normalization taking place, the same exact price action for John Deere as Starbucks. Again, this is unprecedented. You'll never see this again likely in our lifetime. This is kind of a once in a generational phenomenon. But these types of takeaways are super important to understand, because the problem is you've got a lot of pundits on TV talking about how the S&P 500 current PE multiple isn't warranted. And, I challenge that notion in many ways, because those people that are talking like that, and these are very, very intelligent people, perhaps aren't giving credit to the fact that if you peel back the layers of the onion and you look at the market from a top-down perspective, they're right. I mean, from a top-down perspective, if you look at the top-down models and the way that they're forecasting earnings, and I'll just go ahead and drop this normalized earnings trend line so you can see that if you pull up the SPX in ZRS, this is the actual index, and you can see there's no trough in here, right? I mean, we've just got FY1, FY2. I mean, it's going to just, blaze with about a 5% downturn in forecast EPS. And when I compare that to the bottom-up models and all the other research that I'm doing, so in the Zacks research system with the composite facility, you can type in SP5M, and you can see that, in fact, we do have a trough, and that this valuation phenomenon that I'm referring to for John Deere and Starbucks is what is also taking place with the S&P 500. This trough right here is basically being considered water under the bridge. And now the buy-side community is looking out, a year or two at what is to be normalized earnings and drawing their valuation conclusions from that. So when we talk about PE multiples, we shouldn't be looking at PE multiples based on trailing earnings numbers. We shouldn't be even looking at PE multiples based on F12M numbers. We should be looking at PE multiples based on perhaps forward 2-year numbers or FY2. Those tend to normalize themselves out quite well, and we have those numbers in the Zacks research system readily available. So the very first 5 options under valuation history price off the charts menu gives you that information. And you can see that the forward multiple on the SP5M normalizes itself back down to about a 19.5 multiple. Zacks earnings certain portfolio, given the quality of the names in the earnings certain portfolio, always trades at a premium relative to the broader market, and we can see that throughout its history. This is the norm. When you do a relative analysis on that, you can see that the S&P 500 is currently trading at a little bit of a premium relative to the earnings certain portfolio. Actually, an 8% discount. It normally trades at about a 14% discount. So S&P 500 a little bit rich relative to the earnings certain. Normally, I analyze these things a little bit inverted, but this is completely off the cuff, unscripted. So I've got them a little bit backwards, which is fine. I'll go ahead and remove this. And you can see a much different picture if we pull up the F12M history, the F12M series. It's going to probably be a little bit higher than 19.5. And I'm just guessing again. So we're at a 22 multiple. And again, the reason why is that even forward 12 months from now, we're not necessarily considered normalized. And we can see this on the John Deere chart. We can see this on the Starbucks chart, right? So we've got to pay attention to what's going on with some of the underlying memberships. So I take, an extreme value stock, an extreme cyclical, and I take what was a superior growth name, an actual name that is and will continue to be a member of the earnings certain portfolio, and you can see why. And take a look at this earnings trough to derive where these valuations are coming from. This is really the only way you can kind of ascertain, what is going on in the broader market, to take what some of these pundits, including, head of research at some of these really, really exquisite, sell-side research firms, and what they're telling us with a grain of salt, because it's not necessarily what's going on. This is not really how the buy side is looking at things, and I'm telling you now how it's done. You can see this exacerbated by simply looking at the Zacks cyclical portfolio. This is another model portfolio that I manage of 200 value names. And this is going to basically exacerbate the economic cycles. And it allows you to more or less, turn up the volume on how the economy is actually being implicated by COVID, and being able to do these these analyses on what really is normalized earnings. And you can see that we don't get back to normalized earnings really here until 2022 or so. We're lagged 1 year, I believe, on earnings now. So if we take that off, you can see it's, 2022, we're still a pretty good ramp up. 23 gets us more normalized. So obviously, valuations here with this run up in price, obviously we're not running up in price based on this downturn. We're running up in price on this expectation that we are going to get to more normalized earnings state. So let's be sure to keep that in mind as we are listening to CNBC and reading the Wall Street Journal. Next thing I want to talk about is some really exciting news, something that I've been working on since 2015. Basically, the earnings certain portfolio, rock solid performance throughout its history, when aggregated, underlying corporate earnings virtually moving through recessions unscathed. You can see that we've had probably one of the best social experiments in our lifetime take place. And the result of shutting down the U.S. economy has afforded me to do some research that I've been trying to do on my own since 2015. And that is trying to figure out which of the 75 names in the earnings certain portfolio would really deliver on results if the entire U.S. economy was more or less shut down. And as a matter of fact, that's what we've got now. So the earnings certain portfolio, 75 names. You can see that it's being stressed, but we will get back to earnings normalization in about a year. It's a really, really quick blip for the earnings certain portfolio. But what I've been able to do with 1 quarter of actuals, plus with a lot of the research that's coming in terms of estimate revisions for the forward year and even forward 2 years, is I've been able to construct and finish a project I started in 2015. In 2015, I set out to produce what is called the earnings certain Admiral portfolio. And at the time, the Admiral portfolio was 20 to 30 names whose underlying earnings stream would be so bulletproof that it could literally withstand any shock that the U.S. economy or even the global economy would go through. And at the time, I even have the spreadsheet with the save date, dated back here from January 7th of 2015 when I started the work. I've got a lot of other iterations of it since. And the issue is that if we were to build something that's going to be really successful, it has to have the same growth characteristics as the larger earnings certain portfolio. And in the past, I wasn't able to match the underlying earnings growth, not only forecast, but historical. And I was not able to match the performance in terms of price. And that's all changed. So what I did over the course of the last month is sharpen my pencil and hit the Zacks research system and literally scoured every single name and ended up with a portfolio of 30 stocks. And we're calling this the earnings certain portfolio, the earnings certain Admiral portfolio. I think I already have it saved in the list here. And what I want everybody to see is how straight this line becomes. And so what we have now, if you look at the underlying earnings growth, we've got forecast earnings growth at 8.57 for the Admiral portfolio. And we've got earnings growth of 8.65 for the earnings certain portfolio. So we've got now an even more defensive portfolio that still performs just like the earnings certain portfolio. Earnings certain portfolio's beta is 0.79. And as you would expect, the Admiral portfolio, even more defensive, only has a beta of 0.67. This is spectacular, right? Several use cases here. For anyone who's looking at the earnings certain portfolio and 75 stocks were simply too large a universe, we now have a 30 stock earnings certain Admiral portfolio that exhibits all of the same characteristics in terms of growth and valuation as the larger earnings certain portfolio. And the performance is spectacular. If you look at long-term performance of the earnings certain Admiral relative to the earnings certain portfolio, they more or less overlay one another. And, you've got even more defense on the downside with the Admiral. And so the story, is just as solid as the earnings certain portfolio itself. So much more suitable for account sizes that with an average balance of say 200,000 rather than trying to spread that across 75 names. Now you've got an option at 30 names. The other really good use case is for advisors that have multi-generational wealth that they're managing, high net worth individuals, and they've got a very large allocation in fixed income and other securities that may be at risk of future interest rate increases, and are looking for more equity exposure. You could still pick up the earnings certain portfolio of 75 names, and you can basically assign a double weight in the portfolio to the 30 Admiral names and make that equity portfolio on the core side even more defensive, and then apply your tilts from there. So a lot of really exciting things coming down the pipe. Tentatively scheduling a webinar to roll this out and announce it on the 24th. But this Admiral portfolio is available now for clients and prospects that find out about it and then ask to have access. But we will be doing a webinar. I will be doing a webinar to officially kick it off. We're expecting it to actually be in the product sometime between the 19th and the 23rd, but we're still waiting for engineering to confirm that with us. So at any rate, I don't know if there's any questions or not from the team. I'll go ahead and take questions. While you guys are thinking of questions and unmuting your lines, I did want to mention the financials, one of our tilt sectors that is obviously been out of favor. You can see what's going on here with the forecast recovery as well. That pretty much looks the same as the average value name or the average cyclical. So again, this is a foregone conclusion. We're now focused on the recovery, and you can see valuations reflecting that. So any questions? Adam, I don't know if you still had a question on financials.
Yeah, excellent. Since you brought up the financials, and I think you spoke about it at last week's meeting, what do you think are going to be the catalysts to bring financials more or less from an out of favor industry to invest in to a more favorable industry or sector to invest in?
Yeah, no, that's a great question. So basically with the financials and kind of my stance on it is that they're in a really, really tough spot, right, to make money net interest income wise. There are some best of breed names in there that if you need to get exposure to financial, I totally support. JP Morgan's probably one of the better names. And, when you're looking at financials, it's really, really important to not expose yourself to the ETFs, more, take a look at the underlying book of assets and take a look at their underlying business. And if you do that, your Bank of Americans, JP Morgan's are probably your best of breed in this interest rate environment. But what it's going to take specifically is, obviously a change in the yield curve itself. So we need to see an upward sloping yield curve, and we need to see spreads widen. And that's going to really help the average bank to earn that important net interest income. And the one thing that I want to alert everyone to the fact that I've heard some rumblings, and this would be huge if it really happened, and kind of a game changer for the financial sector, is to watch out for the Fed actually intervening in the Treasury market specifically. There's other ways to do it, but specifically in the Treasury markets, to actually change or force a slope change in the yield curve. And they can intervene on the long end and the short end of the curve. Buy the short end, sell the long end, and really steepen that yield curve, and that would be really good for the financials. So that would be another catalyst that I would pay attention to. So that was a great question, though.
That's right.
Anything else? If not, we can go ahead and wrap up today's strategy session. All right. Thank you, everyone.